and welcome to the Assay. I'm here today with Hedley Widdup, Chief Executive Officer at Lion Selection Group. So Hedley, thanks for joining me here today.
Hey, g'day, Amy. It's nice to be talking to you. Thanks for inviting me on.
Absolutely. Always a pleasure to have you here at the Assay. So I thought we could start off today's interview just looking at some of the major trends that you're seeing across the commodities markets at the moment. What's of most of interest?
Well, it's almost like a two-speed market. I know people often resort to that cliche, but we've seen a number of things over the past, let's call it 3 years, which have had, real investor attention directed towards them, and often because it's been a spike in a price. But in the last 3 years, we've seen most of those round over their top and then come off. So lithium was a thing. Uranium is probably the most recent, and that's been in a bit of a downtrend through 2024 as well. Most of the main commodities, copper, iron ore, etc., have softened between 2023 and 2024. So we're seeing commodities generally being weak, but then on the flip side of that, you've got gold, which is attracting, I won't say real investor attention because that's an interesting one, but it's definitely had some buying behind it because the gold has been hitting new record highs, and that should be fantastic for gold miners and gold equities. But I suppose you'd say that's where it breaks down a bit because we haven't seen quite the investor attention that I would have expected towards gold in a really robust gold price market. So there's some great reasons for that, but I suppose they're the high level commodity trends which I'm seeing.
And so, you mentioned these high gold prices that, especially within the last year, we've been seeing. So, do you think these prices are here to stay? Where do you think that market's going to be heading?
Well, I think the easiest way to say gold prices have been provoked higher by buyers out of the East. And people talk about central banks and things like that. Yeah, the Chinese central bank has been very prominent in that. In the last 24 months, I think for 18 of those, the Chinese central bank was a massive buyer. So, that's an obvious source of buying. The Chinese retail and investment market had mimicked that to some extent as well. But there is buying from a lot of BRIC nations, which has been pushing up the gold price. And over a lot of that period of time, the Western ETFs had been sellers of gold. So the Western ETFs, which is just where a person can buy a share in a exchange-traded fund, which gives them exposure to gold as a product of that, they've been sellers. And traditionally, for the last 20-odd years, they'd been the price setter for gold. So if the ETFs were buying, gold price would go up. If the ETFs were selling, price would go down. So you've got this kind of East versus West. You've got the Western market, which hasn't been a believer of gold, and the Eastern market, which appears to be. The Western market is what's pricing gold equities primarily. So that's, I think, where you see the breakdown. Where's that going to go? Well, I think it's interesting that the Eastern market has been so robust. So that makes me sit up and take notice. And that falls against a backdrop of two things. First of all, the invasion of Ukraine via Russia led to US dollars being confiscatable assets. And that point in time is where you've seen this amazing Eastern interest come into the gold market. So, what's causing it and how long will that persevere? Difficult to say, but that's one factor, and it's real. It's been demonstrated, and it's caused a massive breakout in the gold price against the factors which have been traditional correlators. The other thing which I think is interesting, a lot of people don't talk about, but it's a chart which some gold watchers throw up, is this happens against a backdrop of not stalling, but it's definitely been flat production growth globally in gold. So for the last 5 or 6 years, production growth in gold has been negligible. It's gone up a bit, it's gone down a bit. These flat spots in gold production that we've seen historically have often corresponded with the start of a gold bull market. It's a simple supply versus demand type of argument, but it doesn't get talked about much in gold because there's always this looming, well, if the gold price goes up, then people will start to liquidate their gold bar investments. And I don't think we typically see that. I think typically gold buying interest is met by production out of the ground. And when production out of the ground is flat, then it can put a little bit of an upwards pressure under the price. So with those two things corresponding, long may it go on. It's difficult to say what gold price should or would be, but it looks as if it should go on to be positive from here to me.
Right, sounds great. And then, looking beyond the gold markets, because you do kind of look across the commodity spectrum. So you started to touch on some of these facets earlier, but maybe you can talk about some of the key points of interest in these other commodities that you look at as well.
Well, look, I think gold up, rest of the commodities down is a feature. But what's driving those is, I mean, there is spectacular long-term demand fundamentals for just about all of the consumable mineral commodities. Copper ties itself really well to, the old world of copper and the new world, which features in the energy transition very strongly. Things like silver, go into solar panels. So for a world which is generating more and more from renewables, that should feature well. And then uranium is a great source of energy, which is absolutely carbon neutral. So once you've built your process facility and your generating facility, uranium doesn't contribute any carbon dioxide emissions. Yet all of those have been falling. We see the same with iron ore. And I think most of those are really just tied, as much as they have great consumption fundamentals going into the future. The overpinning factor here is that the two biggest economies in the world have got question marks over them as far as their long-term growth. The US, which is one of those, has an election coming up in November, and that is probably one of the biggest question marks which has hung over that economy, is when you've got Donald Trump potentially coming back to power. I mean, he talks about what his policies are and he has a track record, but does that paint itself as a positive? I'm not entirely sure that it does, particularly from a global economic perspective. The US might perform differently under him, but will that be good for its position within the global economy? Well, we'll just have to wait and see. And the Chinese economy, the other big one, is really creaking under a reasonable history now of needing to provide stimulus to keep the economic growth party going, and it looks very much as if the willingness and capability behind that is dropping away. So the Chinese market doesn't look like it believes in itself all that much at the moment, and I think it needs to solve some problems within its real estate market in order to show itself as a big consumer going forward. So with those two factors in place, the next 10 years look fabulous from a commodity consumption point of view, but the next 12 months do look a bit problematic. And that just aligns with a typical commodity cycle. We've been in a down leg of that. We know that after you go through commodity busts, you get back into a boom. So I think the long term looks quite encouraging. It's just a period of slowness in the meantime.
It's pretty well into, you are famous for your line selection clock. So maybe you can talk a little bit about where the markets are now in terms of positioning there.
Yeah, sure. So I think we called the time rounding off 12, which would be the absolute top of the boom. We were calling that in early 2023. And in retrospect, looking back over charts, it was more accurately probably sometime early in 2022. So that puts us 2.5 years into a down cycle. That's been felt most strongly by the juniors and the microcaps, the explorers, probably more so than in previous cycles. And in this case, it's been overprinted by an equity market risk appetite, which has avoided small caps. It's really pushed money into the large cap, more sure plays in the market. So that's benefited the BHPs and the Rios of this world, and I think that's probably enabled them to outstay some of the commodity price fluctuations that we've seen. But with most commodities looking like they've had a top in their peak pricing and have come off a bit, we've seen BHP and Rio Tinto, etc., all roll off as well. So in 2024. They've been a downtrend themselves as well. So where that puts us, our calling of the time at the moment, and take that with whatever pinch of salt you want, because clearly we've looked back and said that our call was a little bit inaccurate for where the top was, but it was a top nonetheless. We're saying 4 o'clock, with 6 o'clock being when you would round off the bottom and go into the early stages of the next boom. Now, I think probably what we need to see between now and 6 o'clock, whether we're at 3 or 4 now, is some level of capitulation where you can say commodities have got to a bottom, and the major equities for BHP, Rio, etc., also get to a bottom. And some of the factors there are probably going to relate to whether or not we see some of the large tech stocks having capital rotate out of them, and what sort of impact on the global equity market, the US election, and concepts of US and Chinese recession play into that. But, give that a year or two, and I think we'll be well on the other side of it.
That's good. And so you are focused mainly on investing within the ASX junior market. Are you seeing any kind of really positive opportunities there?
Yeah, definitely. We invest in the smaller stocks in that space. Those smaller stocks, so if it was a subset of ASX-listed resources companies that are capitalised at less than, say, 250 million market cap. Now, there's an awful lot of companies that fall into that basket. Their prices are down by about 75% in 2 years. So we went to cash in 2022. Our NTA became 90% cash at that point. We've been investing, but most aggressively in the last 6 months, not because we see that we're at the bottom, but because we think that within the next year or two we'll go through the bottom. So we're kind of averaging our way across that. So there was an awful lot of things. First, it was gold. That's where we saw the best value early on. We're starting to see the fantastic value creep into the so-called critical mineral space, as a lot of those equities have come well off of their peaks as well. To see that value, you've got to see a project which you think is going to work at some stage in the future. But there are a number of those which we like, and we're seeing the pricing being very attractive. So yeah, lots and lots of opportunities at the moment. I guess a lot of the market is moving away from that, so we're being contrarian. And the reason we feel that we can be contrarian is we feel like we've got ample liquidity to be able to stay liquid through an extended period of building those positions, which, a lot of investors at the moment are facing liquidity issues rather than the ability to be able to deploy. So we're very fortunate like that.
And I mean, you certainly already touched on this in your discussion about the clock, but, I suppose just some closing thoughts on the commodities markets for, the time ahead and what we can be kind of on the lookout for moving forward.
Well, look, I'd be on the lookout for new sources of demand coming into the market and having an impact on prices so that they start to kick up. And this is probably outside of gold. Copper, iron ore, some of the bigger markets, they do look like they've got a bit of weakness to take us into 2025. But as we go through that electoral cycle in the US in particular and into 2025, and new policies start to get rubber onto the road, I think that's where you could start to see some consumption trends turning, to changing direction and heading positive again as early as that. But 2025, I think, is going to be a year where we see a lot of those things turn the corner. We're going to see new iron ore supply come online in West Africa. I think that's probably going to be a little bit tough for the producers of iron ore in the rest of the world, because that's going to be cutting their lunch a bit, and new supply going into a fairly static demand market, or certainly not a rapidly growing demand market, will have an effect on price. But we don't see that in many of the other commodities. So iron ore is probably not one to watch, but we're seeing a lot of the majors look to strongly pivot their revenues towards copper. And I think that's because they see that as a market which is going to be pretty firm going into the future as well. So whilst it's been soft this year, I think 2025 is time to look for a bottom in copper as well.
Sounds good. Well, Hedley, it's always really great to be able to catch up with you, and hopefully we'll be catching up in Australia in 2025.
Look forward to seeing you, Amy. And thanks very much for taking the time. It's been a pleasure to talk to you and be part of the Assay again.
All right, thanks.